December, not only a time for shopping and spending, it's a great time to think out of the box on how to save some money on your income taxes.
Donating to charities and paying extra on retirement accounts, they're obvious moves, but there are some little-known strategies that could really help. Joining us is certified financial planner David Ray of financialplannerla.com. Good morning.
Good morning.
The holidays, we know, time for gift giving. You're doing a lot of shopping, but apparently gift giving can also give us a little boost with our taxes. How so?
It can. We're year-end, so it's really the time you want to think about what you can be doing to lower your tax bill, because the year's about to end. But with gifting, a lot of people try and just gift money to their kids to pay for college or medical bills or pay off some debt. You want to maybe pay that debt directly so that you're not getting hit with a gift tax. Basically, there's limits on how much one person can give to another person each year, and it's $14,000, which may sound like a ton of money, but if you're paying college tuition, that doesn't go very far. And you want to avoid paying a gift tax, so basically pay that bill directly to the university or a medical practitioner, those types of things.
Oh, okay. December, also a big month for pet adoptions. KTLA has a pet drive happening tomorrow. How can fostering a pet actually pay off on our tax returns?
We gotta love pets. I have two rescues myself. But basically, fostering a pet is tax deductible. People wouldn't think about it. You might not really think it's a big deal, but you're probably buying food, you're buying pet supplies, and that's a charitable expense that you're incurring. So anytime you do something charitable, I know some people in the studio have done bike rides for charity or volunteer. Any expenses you incur for those charity volunteering can be used as a tax deduction, and people really don't think about that. They don't really think, oh, I spent $100 on a fundraiser, or I walked to or I drove my car to Pasadena Humane Society to adopt a pet or foster a pet.
But with the pet thing, is that a one-time, or can you, as you're buying
Any
food
expenses, if you're fostering the pet rather than adopting. So if you're fostering a pet, as long as you're fostering that pet and any expenses you incur, if they have to go to the vet, you foster a sick dog, which can happen quite often, you can deduct those expenses. It's just something to think about.
Yeah.
Because people forget.
Yeah, next, deductions for things that keep us healthy and fit, from vitamins to installing a swimming pool.
So anything a medical practitioner tells you need to improve your health is potentially tax deductible. So the big story here is someone that was able to deduct a pool, which sounds amazing.
Nice.
But before you start digging, talk to your CPA and financial planner and make sure that you actually have the proper documentation. And there are some restrictions, obviously, on that. Otherwise, everyone would be trying to deduct their pool. And with
a slide, like our video here.
Slide, that would be nice. I do want that
tiny
pool, and it would be much easier to do if it's tax deductible. But make sure you do have a legitimate medical issue. But you can do things like potentially massage and acupuncture. There's a lot of things, a wide range of things that can be helping your health overall that you can deduct that people probably don't think about, because they're probably just thinking, I went to the doctor, I have a bill, I have my prescriptions. But beyond that, there are other treatments and other things you've done.
Okay, and you say there's a little-known strategy on the mortgage deduction.
Yeah, so basically everyone knows that if you have a mortgage, you can deduct it. But if you're paying principal mortgage insurance, it's very common here in California to maybe not have the 20% down. I don't recommend not having the 20% down, but you're probably going to have to pay a thing called mortgage insurance. And if you're paying it, you probably know it. It's a few $1,000s a year depending on the price of your house. People forget to deduct that. They go when they're doing their taxes, they pull up their mortgage interest and they deduct it. They forget about the mortgage insurance, which again could save you another $1,500 to $2,000 a year off your taxes, potentially.
And finally, how everybody can save to earn.
Yeah, this is another thing people forget. They're like, I don't make enough to save any money. Well, if you're making less than $62,000 as a married couple, potentially, you can get a tax credit on top of a tax deduction for putting money into retirement accounts. So you might actually even be able to do a Roth IRA where you don't normally get a tax deduction, but still get a tax credit for putting money in. And for a family, that could potentially save $2,000 off your tax bill. So that's $2,000 for just saving for your future. And we all know, I think we'd all like to stop working at some point in time. I love what I do. You guys love what you do. But it'd still be nice to have the option and to be financially independent and not have to work.
Yeah, that's huge. All right. For more information about these tips and David Ray, go to financialplannerla.com. Thank you very much.
Thank you.
Thanks, David.